Welcome to the Goose Hollow Capital Weekly Market Update. In this edition, we recap recent events, preview what's on the horizon, and share some interesting charts that caught our attention.
Welcome back for the deep dive this week. Welcome back to another deep dive. Today we'll be focusing on insights for the sophisticated investor, like you, keeping an eye on the financial markets.
That's right, the financial landscape is always changing.
It really is. We'll be looking at some fascinating stuff. Election predictions, credit market signals, and the potential impact of some pretty interesting policy changes.
Sounds good to me.
Should be a fun one, I think. So let's jump right in, shall we? The election, obviously a big one. What are you seeing out there in the prediction markets?
Well, we're seeing, it's actually pretty interesting. The prediction markets seem to be telling a different story than the traditional polls.
Really?
Yeah. You've got polls showing a tight race between Harris and Trump, but the betting markets are heavily favoring, a Republican sweep.
Interesting.
And what's even more interesting is that the probability of this Republican sweep assigned by these markets, it's been increasing pretty dramatically.
Yeah.
Dramatically.
You know what? We've actually got a chart, I think. We could show that to the listeners. This probability shift over time. And it's pretty striking.
Oh, yeah.
But what does this all tell us? I mean, are the markets seeing something the polls haven't picked up on? Are they just, maybe overestimating the likelihood of a Republican victory? What do you think?
Well, betting markets, right. They aggregate the wisdom, you could say, or at least the bets of a huge number of people.
Right.
So it's possible this discrepancy could suggest that, well, there's a belief among some investors that maybe factors that polls aren't fully capturing, like last-minute news or maybe shifts in sentiment, things like that, might end up favoring Republicans. It's interesting, to say the least.
Yeah, that's a really interesting point. So we've got this disconnect between the betting markets and the polls. It's about the credit market, where we're also seeing these kind of mixed signals.
Yeah, for sure.
Like, on the one hand, we've got these, pretty tight high yield and investment grade credit spreads, right? Which, you'd normally say, okay, that points to a healthy economy.
Right.
But then you've got wide agency MBS spreads,
right,
which kind of, suggests there's this heightened level of uncertainty, probably election related.
Yeah.
So what's going on there?
You know what makes it even more apparent, this whole difference, is when we look at those spread percentiles across, well, all the different asset classes.
Yeah.
Like going back to 2010.
Yeah.
It's kind of like different parts of the credit market are looking at things with totally different lenses.
Yeah, very interesting. So to add to this whole puzzle, we've got Fannie Mae and Freddie Mac preferred shares. They're rallying.
Right.
Now, everyone seems to think that, okay, if Trump wins, that means privatization.
A lot of people think that, sure. But, I wouldn't exactly say GSE privatization is a done deal, even if he does win.
Oh, really?
Yeah. I kind of see it as a long shot, actually.
I'm sure our listeners would love to hear why you think that.
Okay, so first of all, I don't think Fannie and Freddie are going to reach that, $300 billion in capital that they need for privatization anytime soon.
Right.
Current projections say, maybe not until 2030. That's a long time. And who knows what'll happen with the politics or the economy by then.
That's a really good point. And I bet you some of our listeners, especially the ones, who are really invested in agency MBS, are probably thinking, wait, hold on. What does GSE privatization even mean for my investments?
Yeah.
It's a pretty valid concern.
Yeah, definitely. But I think it's, we got to look at history here. What happened before. We can't just, freak out. So, 2006 to 2008, right, when the GSEs were, under all that scrutiny last time. The spread between the conventional MBS index and the GNMA MBS index, that one that's got the explicit government guarantee, well, it only widened by 10 basis points.
Oh, wow.
And that was before the conservatorship even happened.
So not a huge shift.
Not really, no. And there's a couple things that suggest the impact today might be even smaller. Funding costs, they might go up a little, but it probably wouldn't be unmanageable. Right now, you're looking at maybe 35 basis points more.
Okay.
And that's based on the spread between, the AAA financial index and agency bonds.
Okay.
The other thing is the GSE credit risk. How much does it really, translate into wider MBS spreads?
Yeah.
Especially now with foreclosure rates so low, we're talking 0.1% on conventional mortgages.
Wow.
Remember back in 2010?
Yeah.
1.5%. big difference.
Huge.
So, it's something to keep an eye on, the privatization thing, but I don't think it's like time to panic.
Right.
We've got to separate market sentiment from the fundamentals.
Yeah, because sentiment can be driven by all kinds of things.
Exactly. Short-term noise, speculation.
Absolutely. Okay. So we talked about those tight, high-yield spreads.
Yeah.
Signaling a good economic outlook, potentially.
Yeah.
But is that the whole picture? I don't know.
That's the big question. Like, are high-yield spreads really pricing in the risks? All of them.
Yeah.
So if you look back, right, at HYG, that high-yield ETF everyone follows, and you look at different macro regimes,
What do you see?
there's a pattern. It's done worse during reflation, what everyone seems to be expecting right now, than it did during stagflation.
Interesting. Okay.
Right.
So,
So maybe those tight spreads are, maybe a little complacent.
right.
Especially with, the election and all the other stuff going on.
Yeah.
Who knows?
So, for investors with money in high yield, it's like a reminder.
Yeah.
Even a good signal might be hiding something.
Absolutely.
Complacency's dangerous, right?
Oh, yeah.
In the markets.
Big time.
All right, let's switch gears a little bit. Talk about oil prices. They've pulled back a bit, right?
Yeah, well, all that geopolitical stuff's calmed down, right? So that's taken some pressure off.
Yeah.
But I think this could have, ripple effects beyond just gas prices, especially for, people who are invested in energy.
For sure.
So Morgan Stanley did this analysis. It was really interesting.
Okay.
About a lot of the, private E&P shale producers. They're vulnerable,
Oh, yeah. To what?
If the oil price drops too low, they can't make money.
Really?
Yeah, a lot of these shale wells would just be unprofitable.
Wow.
Like 35% of them, if oil goes down to $60 a barrel,
Okay.
20% at $70. And some need over $100 to break even.
That's not a good spot to be in.
No, it's not.
So what does this mean for our listeners with energy stocks? Are those investments, as safe as they seemed a few weeks ago?
Well, every investor is different, right? You got to think about your specific holdings, how much risk you're comfortable with, your overall strategy, all of that.
All right.
But, this Morgan Stanley report shows how important it is to really understand those underlying costs and how sensitive they are to the price of oil. You can't just assume the price is going to stay high forever, right?
Right.
That's the big takeaway, I think.
Yeah, I think that's a good place to pause for now.
All right.
We'll pick this up next time.
Sounds good. It really does add a whole other layer to energy investing. So from oil fields to, something a little bigger picture, shall we say.
Sure.
Let's talk about solar.
Oh, yeah, the sun. There was this World Bank study I saw recently. Really interesting.
Yeah.
They were looking at, the practical potential of solar power, photovoltaic power generation.
Right.
Around the world. But they took into account, technical limitations, land use, all that.
The realistic potential, yeah.
Yeah, exactly.
Huge.
Yeah, it is. It's amazing how much potential there is, even with all those constraints. And they had this global map, showing the irradiation levels.
Oh, yeah, I saw that.
Pretty cool visual, right?
Yeah.
Really shows how much it varies, depending on where you are.
Oh, yeah.
Now, for those of us who aren't, solar experts, what exactly is global horizontal irradiation, GHI?
Right. So GHI, it's basically how much solar energy hits a horizontal surface over a certain period of time.
Okay.
It's super important because it tells you how much electricity a solar panel can actually make.
So places with more sun, higher GHI, more potential for solar energy.
Exactly.
That makes sense. So for, investors like our listeners, sophisticated investors, always looking for opportunities, this kind of information is like gold.
Yeah, absolutely. It can help you find those prime spots where the sun is strong.
Yeah.
You can invest in solar projects there, make better decisions about where to put your money in renewable.
Okay, speaking of opportunities, let's talk about palladium. Price has gone through the roof lately.
Yeah, that U.S. petition to sanction Russian palladium, that's really shaken things up.
It has. We saw a jump of over 10%, overnight.
Crazy.
It's a reminder that, geopolitics, it matters. So what is it about palladium that's got everyone so worked up?
Well, Russia, they're the biggest supplier, right?
That's right, yeah.
40% of the world's palladium comes from them.
Wow.
And it's in everything. You need it for computer chips, catalytic converters, you name it.
So if those sanctions actually happen,
man,
it's going to be chaos.
Supply chains, prices, costs, all of it could be messed up.
Yeah, investors in tech, automotive, those guys especially, they need to be paying attention.
Absolutely.
Now, I hear Europe might not be too keen on these sanctions.
Yeah, they're pretty reliant on Russian palladium and titanium, too.
Right.
So they're, hesitant. Well, they don't want to mess up their own industries.
Understand. Okay, let's switch gears again. Talk about something maybe not everyone's noticed. Share buybacks in mainland China. They're going like crazy.
Oh, yeah. It's pretty wild. Way up this year. And IPOs, they're down.
It's like they're, what, prioritizing buybacks over issuing new shares?
That's right.
We've got a chart, I think.
Yeah.
Shows just how big this trend is.
Yeah, it's pretty striking.
So what's behind this? What's it say about the Chinese market?
Well, I mean, some people think it just means companies think their shares are cheap.
Like a buying opportunity?
Yeah, they see it as a chance to, get a discount on their own stock. But you always got to remember, the Chinese market, it's its own thing. There's a lot going on. Slowing growth, debt, trade wars, all that stuff.
Right.
Investors need to be careful, do their homework,
Look beyond the headlines.
Exactly.
Okay, let's bring it back home, talk about the U.S. housing market. We all know prices have dropped from that 2022 peak.
Yeah, big time.
Especially in those really hot markets, right?
Yeah.
Austin, Boise, San Francisco, those places.
For sure.
They went up the most, so they've come down the most.
Hmm.
We've actually got, I think we have a map that shows this.
Oh, cool.
Yeah, really shows how it varies across the country.
Mm-hmm.
So real estate, it's cyclical. That's clear. But what's crazy is, even with these price drops, it's still really hard to afford a house.
Oh, yeah. Affordability is still a huge problem.
It is. And Fannie Mae, they did this analysis, right, about how to get back to, pre-pandemic affordability levels.
Oh, wow.
It's interesting stuff.
What did they say?
They said we'd need one of three things.
Okay.
Prices would have to drop another 38%.
Ooh.
Or incomes would need to go up 60%.
Okay.
Or mortgage rates would have to plummet to 2.35%.
Wow.
Pretty drastic, right?
Yeah.
It really shows you how much things have changed.
It does.
So if I'm an investor, right, trying to figure out this crazy housing market, what do I need to be looking at?
That's a good question. It's tempting to just go for the cheapest places.
Yeah.
But you got to think long term, Look past the ups and downs. Focus on the fundamentals.
So population growth, jobs, all that.
Exactly. That's what drives value over time.
Not just chasing low prices.
Right.
Got to find those markets with real growth potential.
Exactly. It's like you got to cut through the noise to see what's really going on. And speaking of signals, those credit markets, they're still giving us those mixed messages.
Yeah, high yield spreads are tight, which is optimistic.
Right.
But then agency MBS spreads are wide, which seems like, election jitters. How do you make sense of that?
It's almost like they're on different schedules, Yeah.
Corporate
credit, it's all about the now. The economy seems okay right now, but agency MBS, it's thinking about what happens after the election.
Right.
What if things change politically, economically? It's looking further out.
So it's not always a perfect picture, right?
Yeah.
Different parts of the market react differently to the same stuff.
Exactly. It depends on, the risks, what investors are thinking, all that.
Yeah, totally. Okay, let's go back to China for a second. Those share buybacks, still find that really interesting.
Yeah.
Buybacks up, IPOs down. It's a real shift, isn't it?
Yeah, it is.
Are companies just saying, hey, our stock's a bargain, let's buy it back?
Could be.
Good for investors.
Yeah.
Or is it something else?
It's possible.
Yeah.
Maybe they're not so confident about the economy. Maybe they're trying to, prop up the price. It's hard to say for sure.
Especially with all this stuff going on over there.
Oh, yeah.
Growth slowing down, debt going up, geopolitics, and then, the regulations are a whole other thing.
Right.
You got to be really careful in China.
Absolutely. Do your research,
Yeah, for sure. Okay, one last thing before we wrap up. Palladium. Still a big question mark with those potential sanctions?
Yeah, it's a tricky one.
U.S. wants them, but Europe's not so sure.
Makes sense.
I mean, Russia, they control 40% of the palladium market.
Crazy, right.
And we need it for everything. Cars, computers, everything.
It's a key ingredient.
So if those sanctions happen, supply chains, prices, costs.
All going to go haywire.
Yeah. Investors got to be watching this closely.
No doubt.
It shows how connected everything is.
Totally.
What happens in one place affects everything else.
It's a butterfly effect.
Exactly. Well, we covered a lot today.
We did.
Elections, credit markets, China, palladium, you name it. Lots for sophisticated investors to think about.
Yeah, for sure. The markets, they never stand still.
That's for sure.
It's all about staying informed, adapting,
Right.
making good decisions with the information you have.
And that's what we tried to do today,
Right.
right? Give our listeners the tools they need to make sense of it all.
Exactly.
Show them the opportunities, the risks, the whole picture.
Yeah. Knowledge is power, especially when it comes to investing.
Absolutely. So stay curious, stay informed.
And happy investing, everyone.
See you next time.
This material is intended for information purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities to any person in any jurisdiction. The opinions expressed are subject to change without notice. This information is not intended to be complete or exhaustive, and no representations or warranties, either express or implied, are made regarding the accuracy or completeness of the information contained herein. This material may contain estimates and forward-looking statements, which may include forecasts and do not represent a guarantee of future performance.